Hello, everybody. Lovely to have you here. And yes, we're going to be talking about some of the most exciting fintech innovations that are coming out around the world, but also want to look at some of the innovations that are also helping some of the fintech uh, entrepreneurs to build the applications that they want to serve their customers. So we're going to take a look at a vast array of innovation, including digital banking in Africa to computing power, how you leverage stable coins, and of course, payment processing. We can't talk about fintech without payments. So we want to talk about that, but also talk about the challenges as well of expanding a fintech company. What does it actually take to go global? So without further ado, because we only have 25 minutes and there's a lot to unpack, I want to get the conversation started with David Sherman. He's a chief financial storyteller, inclusion specialist for IONET. AI, we've been talking a lot about that today here at the summit. It is very instrumental in helping to shape fintech innovation, but there is a problem. It's very, very expensive. So you have those who can build and those who cannot build, not just in fintech, but across other sectors. I wanted to start off with you, David, because I would assume some amazing things to help level the playing field to allow people across the world to actually build the fintech that they need to serve their customers. So tell us a bit more about IONET and how it's leveling the playing field.
Thank you, Georgette. So IONET does, at its base, something called distributed compute. So basically, if you want a GPU right now, as most people know, you go to AWS, you go to Google, you go to one of these hyperscalers, and you pay a lot of money, if you can get one, because you're probably going to be on a wait list. And so most small companies are actually struggling with access to chips, and they're struggling with the cost of chips. A study just showed that an AI startup will burn 60% of its budget on infrastructure alone. And that means most of them will fail, and most of them will never get a product to market. And that is a terrible place to be. So what IONET's doing is trying to fix that by increasing access and by making things more affordable. And the way we do that is we actually take underutilized, underutilized GPUs from around the world, and you would think there wouldn't be that many, but actually up to 80% of the world's GPU supply is actually sitting idle at any time. So you hear in the news all the time, people are building new data centers, they're building new electrical plants to power these data centers, but what they're not saying is most of these chips are actually sitting idle. And that if we can find a way to make these chips available to people, the people who really need them around the world, not the giant enterprises, they can go to AWS, but the people building small businesses, particularly in places like the Global South, then all of a sudden we can level the playing field, increase ability to build in AI, but also not just in AI, but in a lot of the industries that actually need GPUs to run well, and that includes things like finance. Because a lot of these services are run on high-intensity compute, and the GPU power isn't there because people think it's not available or locked behind closed doors. So what we're doing right now is we have actually built a transparent network where we collect GPUs from around the world, and the network is globally distributed. I think we are in 138 countries right now. We have GPUs available, which is incredible. And you can come, and you don't just rent one GPU, but you can get a GPU in somewhere in Africa, you can get one in India, you can get one in China, and we can actually create a cluster for you. So you have the full computing power you would have from going to a hyperscaler, but you can get it for usually about 70% less than you would pay at AWS. And that is the difference between getting your product to market and not getting your product to market. So that's what we're trying to do at its base level. We are working with a lot of companies right now who have actually been able to scale because of this affordable compute.
That's amazing. And if you could just sort of, paint that picture of what it actually looks like for people in emerging markets, that's where the vast majority of the population lives, trying to build fintech applications, but they don't have access to AI. What does that look like? You've got some really interesting case studies that you've shared in the past with me, just to give some context for our audience.
Yeah, for sure. So I think there's a couple things, right? One of the things, and you'll hear on this panel, because it's a great panel for this, that when you build a product, you are building for someone. When most of these large corporations are in the US, they're building for Americans or building for Europeans in American and European markets. And guess what? That doesn't work. It does not work if you're in Kenya. It does not work if you're in Ethiopia. It does not work if you're in South Africa, because the model that you would need is completely different. right? It is one thing to work for build a fintech in an affluent market for a relatively affluent market. It is a very different one where you're building on $1 a day. Right? That is a very different thing, right? So what happens all of a sudden is people start building products for the places they are, right? Not just for the market, not just for the investment, but actually for the people, right? And that is a vast, vast difference. Now, we've seen this with a few small companies. Like, look, I mean, we've worked with companies from 2 people building AI projects to teams of 10s and 20s of people, dozens of people, trying to retool or add AI features into their products. Because it doesn't really matter what status you are, or what stage you are of building. If you're a startup, great, amazing, bring your product to market. But also, if you're a scale-up and you want to add AI capabilities into your financial app, good luck. Same problem. Same financial problems, same structural problems, same access problems, and the same time problems to make it happen. So what we're able to do is, if you want to spin up an instance, and sorry, I won't get too technical because I know this is more finance than it is tech, but if you want to start spinning up GPUs, you can do that in 2 minutes. That's an incredible thing, because we have seen, particularly we've seen a lot of customers in Eastern Europe and parts of Asia who, we were just talking about this, where you all of a sudden knew like 11/11 comes along, or even just Christmas, we saw this. The usage peak before Christmas in Eastern Europe was massive. But you can't just go to AWS and spin that up, right? Because people need the financial apps. Oftentimes buying online is challenging, but you can't just spin up for a short time using these hyperscales, and we can let you do that. So it's a massive difference. It creates so much more opportunity for people to build products for their markets and make those products available when people actually need them.
So truly leveling the playing field. Thank you so much. I now want to turn to John O'Connor. He's the founder and CEO of RealFi. He's leveraging what is probably one of the most important innovations to come out of the world of decentralized finance, and that's stable coins. Hundreds of billions are in circulation, and it's also the most under-leveraged digital currency at the moment as well. I wanted you to tell us a bit more about RealFi. What's the vision behind it, and what sets it apart from other potential competitors on the market?
Thank you very much, Georgia. So to sort of understand the opportunity with stablecoins, I think it's helpful to talk about why they were created and what people actually use them for. So there's about $350 billion of stablecoins and about $2 trillion of other crypto risk assets. Those crypto risk assets you're used to. This is your Bitcoin kind of stuff, right? This is people believing across the long time they'll trend in an upward direction. But they also trend in a very rapid downward direction at points. So, the first stablecoin, USDT, was really created so people could leave their crypto exposure. They could sell their Bitcoin, not for another highly correlated risk asset, like another cryptocurrency, but they could go into dollars. Would you believe it? That capability didn't exist until like 7 years ago. So that was the reason why stablecoins exploded. But as they did explode, people started to realize that there's something pretty powerful about them. If I'm going to send money across the world, typically what we need is pots of money on either side. There might be a SWIFT message, and even if it's going to be credited on the account in the other part of the world, the actual settlement will typically take a lot longer and would often also require like correspondent banking and intermediary banks. With crypto, the transfer is the settlement. So the moment the transaction happens, settlement is happening at the same time. It's instantaneous. And that obviously has a lot of advantages, not just in terms of cost and speed, but it's just attractive in terms of what you can start programming that money to do. So to sort of summarize on this, basically stablecoins have gone from being a real like get out of your crypto risk kind of thing towards, hey, maybe this is kind of useful for cross-border settlement and for a number of other applications. I'm based in Kenya, and a number of the factories who produce your toilet paper, who produce your FMCG goods, they pay all of their Chinese suppliers in Tether, in USDT. Because we haven't even touched on the compliance issues that people often have with having dollar bank accounts in different parts of the world and the slowdowns that can happen around that. So there's definitely a regulatory argument as well, why these are becoming very popular in emerging markets. And then the final reason is because, of course, people can get out of their local currency exposure. In a lot of places, getting a dollar bank account is actually not that easy. There are large amounts of fees on it, and it generates no yield. So this is really the space, I think, in which stablecoins have come to play. From a RealFi perspective, we see this $350 billion growing at sort of 30-40% CAGR as a huge opportunity, given the vast majority of it pays no yield. When Tether created USDT, the value of people being able to get out of Bitcoin was so great. No one was thinking, wait a second, you're taking the actual dollar I give you, and you're going and buying T-bills, and you're taking all of that yield, well, maybe I should be getting some of that yield. No one cared, because they were getting out of Bitcoin, and Bitcoin was crashing, 70% of its value. But the world's moved on, and as the market has grown, it's time to sort of start approaching this problem, that out of this $350 billion growing very quickly, not all of the yield should be held by the issuer. And this is basically the space which RealFi looks to play in. We've created our own US dollar stablecoin, which is collateralized by a mix of corporate paper, CLO ETFs, investment grade stuff, T-bills and money market funds, to basically give a sort of 75% liquid portfolio within a week. And then the remaining 25% we do actually in direct lending towards FinTechs across the world, some of which are in markets like yours in South Africa, some of which are in other places. So together, we blend that together into sort of 7-8% yield, liquid yield, which has one key characteristic going for it in crypto, which is it's uncorrelated to the rest of crypto, which is something that I think within the crypto markets people sorely need. So just sort of summarize with a one line, stablecoins are a huge and massive growing opportunity. The vast majority of them currently behave like dead capital. This is very unusual in finance. We are building the mechanisms to be able to provide uncorrelated yield from the rest of crypto towards a digital dollar, which anyone can hold.
And why now? Why do you think now is the time to launch a product like RealFi?
I think partially, honestly, the regulation globally, which isn't necessarily always going in the direction I want, really has sort of opened up that conversation. We've had some big players enter the market. BlackRock with its Biddle bringing treasury bills on chain. A number of other players have basically broken the back of that institutional conversation now. So then the question starts to become, globally, could this be a substitute for banking, right? Yeah. In the future, what does that look like? And for any of you guys who followed the conversations in the United States over the Clarity Act, you have people like Jamie Dimon very concerned over the idea that a stablecoin issuer could pay a yield just by someone holding that stablecoin, because it starts to look a lot like what retail banking gets, particularly with very old school retail banks with horrible experiences. A nice new flashy app that gives you higher yield could be there. So I think that's opened the conversation, and the market's matured enough that these products, and big enough that these products are now ready for prime time.
Yeah, thank you so much. I don't know how many people in this room actually hold stable coins. I do. I do, because one of my clients were based in Africa, and they struggle to pay me in any other form of currency because of IBAN discrimination. So I always say I can test people's privilege by asking that question. So, but there is hundreds of billions worth of stablecoin in circulation. So it's a really interesting business that you've set up, and I don't think there are any other sort of competitors out there that are doing what you're trying to do. And 8-9% return on investment, that's pretty spectacular. So I wish you all the luck. I want to talk a bit about payments now, because that's obviously something that resonates with a lot of people in the fintech space. Merusha, Naidu, you work with one of the biggest fintech companies in the world, Paymentology, focused on card issuing and payment processing in over 60 countries. So you're a South African born, but truly a global person. I love speaking to you about all the things that you've done with the company. For this conversation, I want to focus on Asia and Latin America. You know the markets there really well. You're an expert. Tell us a bit about some of the trends that you're seeing at the moment in fintech.
Perfect. So thank you for having me, Georgia. Really great to be a part of this amazing panel. I love talking about Asia and Latin America, purely because it's so diverse. There's so many different cultures and different types of customers that we're trying to solve for. And I think that's what's really so interesting. And I think, Coen, you and I were having a discussion earlier about how customers across emerging markets have very similar needs, right? So let's look at Latin America first. When you look at what fintechs in Latin America are doing, they're really trying to solve for a problem on the ground, right? So it's real life problems for real life customers where there are a gap. It's no longer just saying, okay, we're serving the underserved and underbanked. It's gotten so much deeper, right? Because fintechs are saying, okay, well, what is the problem in Mexico? A problem in Mexico for Mexican customers is they don't have access to US dollars, right? So we're working with an amazing fintech called Dollar App. And what they do is they issue a USD card to Mexican citizens. Now that makes everything from real-time payments easier, travel cross borders. It just opens up a whole world of opportunity to these customers, right? We have another amazing customer, Rain, and what they're doing is making crypto available for everyday spend. So again, it's solving it's a real-time problem for customers today. And they're saying, okay, let's use financial tools that already exist, like a card, but make that the mechanism for enablement and true inclusion. Because I think we all talk about financial inclusion as a buzzword, but how does it actually work? And adding something that we already know is tried and tested in real time, like a very simple virtual card, but linking that to a crypto-backed wallet and allowing customers to do real-time transfers, that is really impactful, right? And so that's what we're seeing across Latin America. But then if you look at APAC, and I was based in APAC for like about 9 years, and just to see the evolution of customers. So yes, we started off with very simple mobile wallets, right? And that was kind of your entry point into the customer. That was giving, so for example, True Money in Thailand. Every single customer has a True Money SIM card, right? As soon as True Money opened up their wallet, their wallet proposition, we had about 3 million customers instantly sign up. So that explosion of customers saying, okay, now I have something that I can actually use to transfer funds to my friend or, to my parent who lives, maybe in a rural town. That was extremely powerful. And so just that enablement of the wallet and then adding a card mechanism to that was instant access to financial tools, which customers actually don't have in APAC. So in Thailand, as an example, even when I was there as a professional, I could only get an ATM card. I couldn't shop online. I couldn't do anything with my bank card. I had to get a True Money wallet so that I could actually shop online. And so when you look at what the fintechs are doing in APAC, it's very much about embedding payments into wallets, mobile wallets, really going to where the customer is at and understanding the needs of those specific customers. Because, for example, it's really about instant digital. That is the way that you create true financial inclusion, right? And so that's kind of some of the trends that we're seeing. Another one is Red Dot Pay.
Okay.
So again, Red Dot Pay, they're really bridging the gap between fiat and crypto. And again, they went from 0 to 6 million customers within a year. Like, what they've managed to do is incredible. And they're allowing, through stablecoin as well, transfers across 100 countries. And so that, again, is creating borderless ways of payments. And that's what I think APAC and LAC are doing really, really well, and where we can learn, in Europe and the UK as well as in the US. Because what they're doing is they're not trying to make existing financial tools work. They're thinking outside the box to say, what does my customer need? How do I actually solve that gap? And it's okay if it's a niche product, but it's borderless and it's instant and it's digital. So that's what they're doing in a really good way.
Amazing. I noticed that time is slipping through my fingers, and I want everyone to have an opportunity to speak. Do you mind if I just ask Coen a few questions? So Coen Jonker, you are the CEO, founder of Time Bank. It's like amazing success story that's come out of South Africa, a bank aimed at the financially excluded. In 5 years' time, you built this bank that went on to go from 0 to 12 million customers, profitable as well, which is astonishing, given that banks take a long time to reach profitability. You've since expanded across Africa and also in Asia. How did you do it? Let's start with South Africa. I mean, how did you build a bank aimed at those who have so little disposable income and also create such a successful business, which is now as well seen as a unicorn in Africa.
Georgia, yeah, I think our story is very much consistent with a theme that I picked up in the conversation today to this point, which is the power of businesses that don't build generic solutions for the world, but specific solutions for specific customers in specific countries. And, our party trick, I can say, in starting our business was a combination of a digital and a physical model. What we did was to build a digital bank, but one that actually took banking into the physical environment, solved the problem of getting cash into accounts very seamlessly, and solved the experience problem of opening a bank account and getting into banking by deploying essentially kiosks and what we call brand ambassadors into communities everywhere that we operated. And what that created was a unique operating model that did two things at the same time. It drove the cost of customer acquisition and customer servicing down. So our claim to fame is with that outside of China for a long time we had the lowest CAC, cost of customer acquisition in the world, which is counterintuitive because you think surely digital must be the cheapest. But actually these kiosks and ambassadors were so productive that the cost per customer was actually market leading in the world. And then the second thing is to accelerate trust. Because it's really difficult, if somebody says to you, download an app and trust these guys are now going to be your bank. Even for sophisticated people, you have a few questions in your mind. But if you walk into your local trusted branded retail store, where you've bought your food for 20 years and they still haven't poisoned you, and they go, this is great, try this, and it's linked to our loyalty program, and you can get cash in and cash out at the till point, you actually accelerate that path towards trust. And that was the combination that allowed us, as you say, to onboard now 12 million customers in South Africa, 9 million in the Philippines, and we're growing at 1 million customers every 10 weeks or so.
I know you're, I think, the fastest growing digital bank now in emerging markets. You mentioned Philippines, so you have 9 million customers. In the Philippines, it took you less than 5 years in South Africa to garner 12 million. Apparently it took you, around 2 years to do that in the Philippines?
Just under 3, yeah.
So how did you do that? Is it like a one-size-fits-all model? You now know how to crack the financial inclusion sector and you're going after it. Explain sort of if there were any differences.
The interesting, I think the nuance here, the yin and yang of it, is that customers all over the world are more the same than you think. And our data analysts and so on tell us that the customers behave, humans behave the same everywhere, but they don't start in the same place. So context can be very different. And I would say the first headline is to understand the nuances of what is the same and what's different, and to be willing to adjust your products and your experiences for that. Number one is very important. I think the second thing is in integrating your products into ecosystems and into customers' lives. I think we're just at the foothills of a vast new landscape of integrated and contextual finance, which is a world in which you are not asking customers to come to you. You show up in the moment that the customer needs you for that specific thing. And so a big part of our success was integrating, in the first instance, our products into customers' retail shopping environments. So you go where they are and where they're comfortable, but increasingly also into their business processes and private processes. So whether that is being able to give a business an unsecured loan at the moment where they need to buy their next stock, or whether it's giving somebody that money that they need to get to the next salary, the more we integrate into customers' lives, into existing processes, the more success we see we're having, and the lower our risks are.
Right. So that local knowledge is super, super important, and that collaboration with people on the ground. And they have to be as committed as you are as well.
Yes, and it gets super specific and super detailed very quickly. So it's not just sort of generally understanding a new country. It's understanding that segment, that customer, and what they need in that moment, which is a whole different conversation. and which is why I'm so excited about listening to the infrastructure and the regulations starting to align, because I see a world where, people say to me, is banking in South Africa and places like that, are we overbanked? Are there too many competitors? My prediction is there will be many, many more, and we will become a lot more specialized in sort of solving these specific problems for people.
Thank you. I'm afraid our time is up. I could speak to you all for hours. Thank you so much for your time. I hope you've all learned something as well. And yes, enjoy the rest of the show, our conference.
Thank you.
Thank you.